questions also you can send to us through Facebook Live. We'll try to answer as much as we can. Raghunathan is a financial expert from the Northwestern, and we are going to ask some questions like, what is the overall physical financial planning? What we need to know. Remember, this is a basic session or seminar, we call it. We will be doing more of other sessions eventually. So we will be doing like a financial structure, including risk management, estate planning, and college going. So this is a good time. The parents are thinking about college as a college for kids, and then the scholarship amount and all that. So we're going to touch all that slowly. Welcome Raghunathan and welcome Ashok. Raghu, you want to start with some basic introduction and your basic proposal for our viewers, please?
Sure. Thank you. Good evening, everyone. For all of you who are watching in this Sunday evening, greatly appreciate your time to listen to us. And me and Ashok wants to take this opportunity to thank Horror International, who is planning to bring this awareness to our community. And the next thing is my sincere prayers to everyone to keep safe and healthy during this unprecedented times. We are all going through, as Raghu mentioned, we are going through a very tough situation, but we will come out strong as we work together. So with that said, I want to go through a few basic things about why do we need to be financially aware of some of the things that is very important during this time. Not only during this time, but any growth that we want to have it in our life. It is all depends upon how we earn and how we spend. So with that said, let me share my screen. Are you able to see my screen?
Yes.
Okay. So before we further start, I want to make sure this is an important disclaimer that we want to make. So whatever we are going to talk, it's not meant to be any legal or any tax advice or any mortgage advice. It's always recommended to go back to your consult your own tax advisor or legal professional or mortgage broker. This event is mainly for educational purpose only. So just want to make sure, if you guys have any questions, you can reach out to us, but this is purely for educational purpose. So with that said, what is exactly is financial planning? So financial planning means many things to many families. It's not one size fit for all. The reason being, as a human, we transition ourselves from different life stages, getting out of college, young married couples with kids. At some point, kids will be out of the home, husband and wife will be empty nesters, pre-retirement and post-retirement. It evolves around 6 to 7 life stage. As we go through the life stage changes, you also want to make sure you are planning accordingly. So the very basic fundamental of planning consists of 3 things. One, you need to first make sure there is a solid risk management strategies that you have put together. Second, you want to make sure there is a good amount of savings that you are doing for your wealth accumulation, either to buy your home or send your kids to college or whatever you want to save for your future. And then the third important aspect is, how do we make sure we are preserving that money? Because one thing is very evident for all of us, correct? So the concept of pension is no longer there. We need to create our own paycheck the moment we retire. Either it is 60 or 65, it doesn't matter. There's no pension anymore. So we need to create our own paycheck. How do we do this unless we know exactly how we want to plan for our future? And then the challenge for many of us who are first generation immigrants, we go through multiple layers in life, coming here from H1, L1, green card, citizenship, 12, 15 years. Majority of us, we don't know what are we going to do, what are our next steps, are we going to be here, are we going to move back to India or any other country. In that perspective, people delay in doing any of those financial plannings. They feel where do I start, whom do I talk to? So when that happens, that's where really you need to take a step back and see what is important to me and how I can do that for me and for my future. So as I said, the three strategies that we want to talk about is make sure like you have a solid risk management strategy. When risk management comes, it is about having some good life insurance for you and for your family, having a long-term disability. All of a sudden, if something happens, not able to work, sick, injury, or any accident that happens, or any diagnosis that happens, prevents you from working, how you can make sure like the continuity of the income comes to the family. In this pandemic, I have seen many cases like within a snap of a finger, people just go not able to work for any reason. So you want to make sure like you are protecting much of your income. And any fundamental of planning comes, as I said earlier, how much you're earning and how much goes into expenses. That's the basic budgeting. Every family needs to do a budgeting. So in budgeting, there is a non-discretionary items and discretionary items. So one of the main thing, majority of the 20 to 30 to 40% of our income goes into paying the home. Everyone's dream is to buy a home, correct? So that at the end of the day, we all here to earn money. At the same time, we want to live happily by having our American dream of buying a home. 35 to 40% of the income that goes towards the mortgage. So there are a lot of great things that you are going to hear from Ashok. What are the strategies that we need to do towards mortgage, and how do you make sure like we are getting all the right things to educate yourself before diving deep there? So I want to stop here for a few minutes, and maybe I will turn it back to Raghu so that there are a few great questions that we want to address regarding the mortgage.
Yeah, thank you, Raghunathan. Ashok, Lakshman, welcome to Aura International. We're very happy to listen to your expertise and all that. You have been in the business for many, many years and helped thousands of customers, I know, and whether that's a Tamil or a Hindi, Telugu or whatever, like you are there at any time. So we have some questions from our viewers, Ashok. What is the real estate right now? I mean, what is the this pandemic situation? Is it good, or it is going really good, or low, or in the medium? What is the situation right now?
First of all, thank you, Raghu, for arranging this wonderful event. Like you said, that this is a little different than what you've been doing. Hopefully, we will entertain the viewers, with our wonderful information. And thanks to the viewers for watching this on Sunday night. First of all, the market, everybody thinking that due to the COVID and everything, what is happening, what's going to happen to my home and the interest rates and everything. The market is pretty hot right now. It's a seller's market is what I probably can say that. Any homes coming into the market, it's gone so fast. So if you want to sell, it's not a bad idea to sell. And same token, if you want to buy, this is the best time because interest rates are the lowest ever we've seen, So this is the best time to invest the money into the real estate market for sure.
Okay, great. So contrary to the thinking that, pandemic, nobody's buying or anything, I think you are telling maybe it's a good time. If somebody is thinking of buying, or they should not be postponing it.
Definitely, because this is the best time. The homes are available. I mean, not that much available for the next couple of months, but next year it's going to be a good year, and we are expecting the rates are going to be like this for somewhat up until next year this time. So interest rate wise, this is almost 1%, 1.5% better than last year. So this is the best time to invest money into the real estate market.
Excellent. I will come back to you, Ashok. I have another question about the refinancing option and everything. So I'll come back to you. Raghunathan, going back now. So now one of the consideration for a lot of parents now being fall semester starts now, or spring is going to be there. And like you said, budgeting and financial planning involves sending kids to the college also. Right, that's one of the important for many parents right now. So what do you have in terms of college for kids?
Okay. So let's take a step back and talk about kids' college education. Right, the second biggest expense we will go through in our life after buying our home is sending our kids to college. Majority of the time till they go into high school, everything comes as a free. We don't spend much amount for the kids' college education. But the moment they step into college, or even before the college, from the junior year, parents need to start thinking about how much do I need to pay for the college. Here, basically, kids can go into three different options. Either they can go into an in-state college, or they can go to an out-of-state college, or they can go to private college. Why is this three different options? Because in-state is considered as a cheaper option because of the tax dollars what we are putting in. You are going to get much benefits of that. To get a ballpark about how much it costed in 2019 for a public university, an in-state public university, it's around anywhere between $20,000 to $25,000. This is for an undergrad for 4 years. This is what approximately it costs. This is an in-state of around 20 to 25,000. And then the private colleges, we are talking about close to $45,000 to $50,000. But one thing is very, very daunting. It's going to be for many parents at some point. The inflation on the college cost is anywhere between 5 to 8%. So, but the normal inflation on any other goods, it ranges anywhere between 1.69% to 2.79%. That's an average on the last 30 years. But this college cost is consistently going up. But we don't know, this pandemic might also shift that thought process about how the colleges are going to work in future. But with the current rate, if you see at 2035, the public universities, we are thinking it might cost closer to 67,000 if the same 5 to 8% continuously grows up. So when we talk about the college, it's not just the tuition and fees. There's a lot of other things also comes with the college cost. So this just breaks down between the room and boarding, books and supplies, transportation, and other expenses. What are the things that I need to be prepared for sending my kids to college? And as I said, there are multiple options the parents can choose. How do they want to do it? But the important thing is the financial aid. So when the kids goes into their senior year, they need to start filling up a form called FAFSA, which I will go through in a detail, because that is where determines how much of scholarship that you can get. Basically, any kid can get three types of college. One is based on need-based. If the parents doesn't have much of the income within the stipulated income, then they can get a need-based scholarship. Then second is academics-based scholarship. Based on the scores, every university allocates some amount into the academic scholarship. And then the third is the artistic and athletic scholarship. If the kids perform or excel well in any of their sports or any other extracurricular activities, then they can get it. So there are two different things, scholarship and grants. And how this works depends upon based on the documents that you are going to fill. And it goes through in detail. There are some great websites federal government has provided where kids can take a look and parents can take a look. And I would encourage every parent who their kids are in the junior or senior year, they have a school counselor who can help to guide them through what they need to exactly know. So some of the things are Perkin loans, federal Perkin loans and federal direct plus loans, which given by the federal government at the lower interest rate might greatly help. So FAFSA stands for Free Application for Federal Student Aid. So there are some typical dates that we need to know, especially when the October month starts. It is very important that they can start filling for the college year 2021 to 2022. They can start as soon as on October 1st of 2020. So you need to have 2 years of your tax return. So 2 years of your tax return to start with to fill all the information. And once you fill this, it goes through a detailed process about how much of scholarship that you can get. There's a difference between scholarship and grants. It's a free money from the government, state, or school. Does not have to be repaid. So grants and scholarship falls under that category. As I said, it can be awarded based on the need or merit, or awarded based on variety of reasons. So the good thing we need to do here is you need to check with the financial aid office for additional scholarship that may be available. So if I split that, let's say the kid is got good grades, and he wants to go into a good college. These are all the three things that we need to look for. First is free. What do we get as a scholarship or grants and scholarship and tuition discounting? Then comes what is the cheapest rate of interest that we can take it for the loan, whether it can be a federal direct loans or federal Perkin loans if available, then you get that second option. And then whatever is the gap, let's say the college fees is $25,000. You got a $5,000 scholarship and another $10,000 loan that you are eligible. So then there is a leftover of $10,000 that you need to come up with. This is where really we need to think way ahead, because you can't do this during the time of college. We need to start saving for that. It can be on a 529 plan, or you can take a Federal Plus loan. So Federal Plus loan is basically parent taking the loan on behalf of the kids, or you can go into private student loans. And the other option is many people also think about doing the home equity loans that can support, but those are all the last option that we need to think. Putting money into the 529 plan is a great option because you get state tax credit for that, and also the money grows tax deferred. When you take it for college, you don't pay any tax on that. So you want to make sure that you are getting the benefits of thinking early for putting money into their kids' college education. It doesn't need to be $1,000 per month. Even if you start with $100, $150, it greatly helps. The compounding value of money greatly works for the kids' college education. So I'm going to stop here for a few minutes just to transition back to you, Raghu.
Yeah, thanks, Raghunathan. Actually, I have a question on that savings 529. We do have, like, for example, Illinois, we have called College Illinois plan. I think that is I'm sure each state may have their own plans. Maybe stress a little bit more, as I understand. So you are paying, if you are into the College Illinois, for example, so they will pay today's tuition if the college kid is ready, let's say in 15 years, but you are paying today's fee, but it will be taken care of like in 10 years or 15 years when the kids are ready. Is that correct?
That's correct. That's correct. Every as you said, every state has this 529 plans designed by multiple ways. The first thing is it's called prepaid tuition, like where you can prepay, though it is going to be 5 years or 10 years from now, you are getting that semester covered right now. That means you are beating the inflation. Even the college fees is going to be $10,000 5 years from now. If it is $5,000 right now, that is what you will get locked into. And then the only I would not say it's a drawback, but what happens is you are just tying up with that particular state and particular college. What happens if the kid is very bright and then he wants to go out of state, or you want to go into private college, then you are locking yourself into that particular prepaid. So the other option is non-prepaid. So basically what happens is you can start putting money into the 529 plan, it grows, and then you can use it for whether in-state or out of state, anywhere you can use it.
Okay, great. For example, the College Illinois plan, as I know, they will pay, even if you go to, like, for example, DePaul University, which is a private school, they will pay the highest amount they will be paying in a university, in a state university. For example, what is the cost of University of Illinois? That rate they will pay for a private institution, as I understand that.
That's correct. That's correct. So college in Illinois has this Bright Start, that the program, every state has their own name of calling that. For example, in Wisconsin, it is called it as EdWest, and for Illinois, it is called as Bright Start. So if the parents are married filing jointly return, so they can put up to $20,000 and they can get a state tax credit for that. And then the money grows. Let's say that $20,000 grows to $25,000 or $30,000. The entire $10,000 of growth that you can pull that as a tax-free if you use it specifically for college purpose.
Excellent, excellent. I think viewers, please consult your accountant or your financial advisor for wonderful opportunities we have. That brings a good topic for our show. Two topics actually. One is the refinancing, and then as I see it on the screen, the home equity. Is that a good advice to take the home equity and then pay for some of these loans? What are the plus and minuses on that, Ashok?
Let me cover the home equity first.
Yeah.
See, the used to be a lot of banks are offering home equity, but not anymore. Due to the COVID and everything, they're afraid that people going to foreclose the home or something. So most of the banks are freezing the home equity line of credit right now. So
Mm.
if you have a line open now, and if you're going to use the money soon, I would recommend to take that money and park it someplace. If you don't need it, but then you can just wait for that. See, the one advantage and with the committee line is you don't pay interest until you borrow the money, and you pay the interest only the money that you borrow. Versus any credit cards, the if you borrow, you have to pay more, and if you got a cash out, you need to start paying the interest right away on that part. But the interest on home equity line of credit is very high. So if you need some cash, maybe you can go and get a cash out on your existing home if you have equity there. So still rates are very low on a cash out. There was 3-4 months ago, most of the banks were freezing the cash out, but now they start opening up one by one. So it's still good rate available for a cash out. So take the cash out from your existing home and use that money. That in a long time period, that is still going to save some money. So the home equity line is just based on people's usage, you know.
Okay, very good. One of our one of our patrons is asking, is it a good time now to refinance? What is the refinance, an average rate or something they're asking?
Okay. Yeah, definitely. Always I say today is a good day. You know, whatever you have, just take it. You never know. Starting December 1st, there is a 0.5 bips hit by the Fannie Mae. That means whatever they are bank is they're collecting, they're going to charge half a point to the rate. So with that, the rate might go up, or most of the banks already they built that into the rate. So with that, still it's a very good rate. So like that, you know, we don't know what other conditions going to come down the road. So if you have a higher rate, if you have a half a point or something, just an example, higher than what is offering right now, I would say go and take it. Don't wait that. Don't wait for like in the next month it'll come back or come down more or anything like that. So still the rates are anywhere between 30 years 2.5 to 2.875. I'm talking about interest rate. With the APR is always more, and 15-year is anywhere between 2.125 to 2.375. But it is always subject to the loan amount, subject to the customers, the credit score. Based on that, we are offering those rates right now.
Okay, very good. We have another question about you may not, or some of the lenders may not do this one, but they want to know the basic concept of a reverse mortgage. So think about it, and then I will come back to you. Raghunathan, I have a couple of questions from our viewers on the scholarship and the student thing. How much debt in an average students have when they graduate?
That's a great question. So if you see the overall, it's around 1.4 trillion. That's the student loan debt that we are in. 44 million people are about to pay their student loan. So if you see the total population is 333 million. So out of this 44 million, almost 13% of the people holding the student loan debt. The average debt is around $35,000. That's what this is. I'm talking about undergrad. I'm not talking about post-grad or medical school students. Like that will be in around $220,000. That's an average debt they have.
Oh my God.
So second to mortgage, the biggest debt people own before credit card is student loan.
Oh my God. Okay.
Yeah.
Okay, I understand because of this pandemic, there is some kind of a relief for student loan. I mean, they kind of frozen now. They don't have to pay until December or something, I was told. Is that correct?
That's correct. So
Okay.
that's correct. So that is called forbearance. So basically, starting March, there is an act that has been passed as a CARES Act, where whoever has a student loan, they don't need to pay till September. So now they are extending it for a couple more months. But this is just forbearance, not forgiveness. So that is a two different things. So forbearance is basically they need to repay again. It is not completely taken out, so they need to once that things comes out, they need to still start paying their loans.
Okay. Okay. Very good. I think Ashok is probably he will come back. I have another question. If I get scholarship, am I eligible also for federal student loans?
Yes, absolutely. Yes. So it is not going to completely take away if you have a scholarship there, because if you get an 100% scholarship, then it's a different story. You might not be eligible, but if you don't get an 100% scholarship, then this is the option that you need to go through. You might still be eligible for the loans.
Okay, very good, very good. Okay. What do I need to keep my scholarship or federal student loan eligible?
So you need to, if when you take the scholarship, you need to continuously pass, and then you need to meet the required whatever the loan needs to be before paying that loan. Whatever the requirements you need to meet, you still need to meet. You can still work. You can work as a part-time. You can make money, but there are certain restrictions that you need to follow through to get the loan still be eligible for you to go into the next year.
Okay, great, great, great. Actually, on the forbearance question, I'm just going back to Ashok. What's happening on the forbearance on the loan issues, Ashok?
So the forbearance is what government is offering right now for the people who cannot pay the mortgage due to the job loss or anything. But I want the viewers to remember that it is not a free money to begin with. You have to pay back. They're just postponing for 90 days or 180 days, depends upon some of the banks. Check with their own bank on that. I would not recommend taking that. Too many reasons. One, you have to pay back anyway. Second thing is, by you taking that forbearance, most of the banks might not able to do the refinance until you start paying back the mortgages 3 months in a row. So you don't want to lose good rates right now, and if you're not able to do the refinance. So I would strongly recommend that don't take the forbearance unless you need to, really you need to.
Okay, great, great. Raghunathan, now let's, before we go to the other like risk management or estate planning, let's talk about few savings options, such as how we can save money by FSA plans. What is an FSA plan? How that benefits the viewers?
Okay, so let me share a screen which might talk about. So FSA stands for Flexible Spending Account. So this is a great time of the year because the open enrollment comes. People are going to register for their next year for 2021, either their health insurance, or their long-term disability, short-term disability, accidental death and dismemberment. All those things opens up. So flexible spending is you can save up to $2,750 per spouse. If both husband and wife are working, if the work offers that FSA, not every employer needs to offer this. If the employer is offering, they can put up to $2,750 pre-tax. What that means is you will get your federal income tax and state income tax will be reduced by $2,750. That is what the FSA is, flexible spending account. But one thing need to remember, this is use or lose. If you don't use it within the calendar year of December 31st, but you have time till March of next year to submit all your receipts. But if you don't use that money, you will lose that money. So you want to make sure, like, are we really need that? How much we are going to spend on this? Either any deductibles or any RX prescription that you can take it, or any vision benefits that you want to pay out of pocket. You want to make sure like how much you are going to use it. If you don't use it, you will lose it.
Okay. Another question
And then,
from a customer: can both wife and husband can contribute to FSA?
yes. So if you see here, both husband and wife can contribute $2,750. So there is one more thing called dependent care. So that the next thing which I'm showing here is dependent care. Maximum they can put is $5,000. There is a cap. If you both husband and wife combine together, that is, they can't put each $5,000. This is for the family, both they can put 5,000. But for FSA, each one can put separately $2,750.
Okay, great. Because of this pandemic and all that, is any extra savings? Like, for example, usually FSA covers the prescription medicine. Now, the over-the-counter medicines also covered, as I read somewhere, Raghunathan?
Yeah, so see, those rules changes every time. So I would highly recommend, before they're going to do anything, they need to look into their employer benefits, and they have a specific link for each employer, what they can spend and what it will cover, what it will not cover. So you want to make sure that you are going through your employer's benefit links and understand what it is eligible for you, because it changes by a lot of combinations. Since we are covering FSA and dependent care, I also quickly want to talk about the health savings account, which is one of the best thing that anyone can have. Because if you see any investments we make, either it is pre-tax, when you take the money out, you need to pay tax, or you will pay after tax. Okay, you will invest after tax. The growth is taxable. HSA is the only account money grows whenever you are putting the money. It is pre-tax. Money grows tax deferred. When you pull out the money, it is tax-free. That is one of the best account anyone can have, but there is a limitation. Everyone can't put money into their HSA account. It is eligible only for a highly deductible health plan. If the company has that highly deductible health plan, for a family, they can put up to $7,100 pre-tax into that account for 2020. So that's one of the great options. If the employer provides that, it should be a great no-brainer to put money into that account. And this is one thing, again, this is not like FSA. Here, even if you don't use that money on that year, it will roll over to the next year. So it does not use or lose. So it is one of the great benefits that they can just continuously use it for 20, 30 years. Even if you don't use it, you will have that money forever.
Oh, that's excellent. That's excellent. Now let's switch back to Ashok. I have some questions from our viewers, Ashok. What type of loan is good for me?
It all depends. Used to be there is a fixed loans and adjustable rate mortgages. So the people, they think that I am not going to live in this home for the next 7 to 10 years or maybe 7 years only. They usually take ARM products. But the last 1 or 2 years, almost the adjustable rate mortgages are gone. When I say gone, they're still there, but the fixed products rates are better than the adjustable rate mortgages. So I would recommend customers to lock the fixed products if you are going to live in their home for a longer time. Or if you think that I'm going to live this home for 7 years, I will grow out of this home and buy a bigger home. If you are going to rent the current home you're living now, again, it's a good time for you to fix the low interest rate right now. So I would recommend always fixed products.
Okay, great.
And when you come to fixed time.
Yeah, continue.
No, I was going to say, when you say fixed, there is always a question people ask me, should I go for a 15-year fixed or a 30-year fixed, And customers always think that, hey, I'm going to pay off the loan earlier, so I'm going to go with the 15-year fixed and save some money. I really don't agree with that. Especially the market is very hot right now. On the other side, or like Raghu said, look at the students' education expenses in 10, 15 years from now. I would rather consult the customers to consult their financial advisor to see, put extra money where 15 versus 30, usually approximately $500 to $800 or $900 difference between the loans. I would put that money aside for the school education or other retirement plan. So if you see that for 2.5 interest rate, why do you want to pay off a 2.5 interest rate when you can grow that money outside more than 2.5 for sure? You know, I mean, again, it's I want them to consult with the financial advisor. So my best product or my recommendation always fixed 30-year is my recommendation.
Great. I have a couple of questions. How much a down payment is required or necessary?
Okay. So the down payment vary according to the home that you're buying. So I'm going to focus on primary home. Even primary home, there is vary according to the customers. So if you're a first time buyer, there is a possibility you can just put only 3% down payment and still get conventional loan, which will come to that in a second. And if it's a FHA loan, you have to put down 3.5% down. But I always would recommend at least put 5% down, because anytime when you put less than 20% down payment, you have to pay something called private mortgage insurance, or they call PMI. To avoid the PMI, you have to put 20%, but not all of them have a 20%, especially this kind of COVID situation or any situation, you want to keep some money in your bank. So with that, put 5% minimum and get 30-year fixed.
Okay. So instead of 15 years, you are recommending like 30 years for the loan.
Correct.
Okay. Okay.
And there is no prepayment penalty, so that people can take 30-year fix and pay like a 15 or 20, anything like that too.
Excellent. Excellent. Another customer is asking, what are discount points and what is an origination fee?
Okay. The origination fees and discount points, sometimes customer wants to buy down the interest rate. Just an example, if I offer somebody a 2.5, and if the customer wants the 2.25 or 2.375 on any product, and they have to buy down, that means they have to pay, other than the closing cost, they have to pay 1 point, 1% of their loan amount or 2% of the loan amount. That's called discount points.
I see. I see. Excellent. There are some questions about closing cost and all that. I will come back to you, Ashok. Raghunathan, now we talked about the college expense and then some other mortgage budgetary expense and all that, and some contributions or something to save some money, such as 401k or FSA or HSA and stuff like that. What is your next cycle of planning in financial cycle?
Sure. So before I go there, I just want to piggyback to what Ashok talked about. This is a common question. People come when I'm doing the financial planning. The first thing they come and ask, how much can I afford for my life, for my home? Correct. So when we do the budgeting, we want to make sure like you are not overstepping what you always. I always tell my clients, you want to bite what you can chew. Otherwise, you are going to choke yourself. Correct. So what is that? You can do it. So the general rule of thumb is there are three things, the expenses you go through. One is consumer debt, basically your credit card and all the other debts, what you have. The general rule of thumb, when your gross income, when you take your gross income and take all your debts, it should not exceed 20% of that. And then when it comes to mortgage, we say like all the mortgage, like the mortgage interest, principal, interest, then the property tax, and then the homeowner's insurance. All those put together, when you take it and you need to divide by your gross income, then it should not exceed. The general standard rule is 28%, but it is some banks will go beyond that. And then when you combine all this together, all your consumer debts and other mortgage loans, you don't want to exceed more than 36% of your gross income. So that's the general rule of thumb that we recommend to go through it. So now I want to go back to the life stages of planning. So which is pretty important, covering both retirement. And this is what I tell my clients. See, for education, you at least you have the option to go and take loan, but nobody gives loan for retirement. If you go and ask someone, some bank saying like, I'm retired, can you give me a loan? Nobody is going to give. So there is always, as an Indian parents, correct? We always feel so great that we want to give. We can compromise on anything, but we don't want to compromise on our kids' education. That is absolutely true. But you also want to make sure like you are saving enough for your retirement. Many times, this is what I come across when I ask my client, how comfortable are you going to be in a retirement? The very common answer I get is, I'm putting money into my 401k. Just putting money into 401k might not give the retirement what we are looking for. There are two challenges. One, the longevity. We don't know how long we are going to live. We know we are going to retire at 60 or 65. Because of all the medical advancement and other things, people are living longer than expected. So in US, every 10 years, they do the census. 2000, they did it. 2011, they did it. In 2020, 2020, they are doing it. In every census, the average life expectancy of men and average life expectancy of women is increasing year after year. So what does that mean? Going back, and the second important challenge, one is longevity. Second is there is no pension. The moment we retire, the 15-day paycheck, which we are getting right now, it is going to stop. We need to create our own paycheck in our retirement. How can we do that if you don't start saving early? Correct. And the biggest challenge is most of the time, people don't even know exactly how to put money into 401k. Even the company gives a match. They don't do it because people take advice from their friends saying like, I didn't put it, so you don't need to put it. But that's not should be the way to look into that financial planning, especially on retirement. So when it comes to retirement, you need to put some time. The normal question comes back and asks, how much I need in retirement, right? So the general rule of thumb, at least you need to have 75% of the expense what you are having right now in your family. You need to make sure like you are aiming for that. And what happens if you don't save enough? Then you need to work longer. Instead of 60 or 65, you need to work till 70. Then the next thing comes is there's a social security, correct? People normally ask, when can I take my social security? So social security is similar, like you are putting a percentage and then your employer puts a percentage. You have three options. You can take it at age 62, or you can take it at age 67, or you can take it at age 70. Why these three options they have given? If you want to take it at age 62, you want to reduce, you will get a reduced benefit. You might not the full benefit what you are eligible for. At 67, you might get your full benefit. At 70, you get a little more discount. I would say everyone who is listening, you need to log into SSA.gov, Social Security Administration.gov, to go and check how much you are eligible for. What has happened previously, every September, you would have remembered, people used to get the statement in their mail. Now it has been stopped. Everything is electronic. You need to go and log in there. Social Security Administration pays three types of benefits. They pay unemployment benefit, they pay retirement benefit, and then they pay disability benefit. You want to make sure like your earnings are properly recorded. That is going to determine how much of Social Security you are going to get. Whether you are going to get 20 years from now or 30 years from now, you want to make sure your dollars are recorded correctly there. Then comes, that is one portion that you can take it. And then next portion is you need to start saving for your retirement. Make sure the money is also last long. I will go through the next slide, which is pretty important. Many people, if you talk to people who are in their 60s or 70s, what keeps you up at night? What are the challenges? One is the market, the volatility in the market. Still, they need they have some money in their stock market, right? With the it is kind of a EKG. It goes up and down. People really feel so tensed when they put their money into the stock market, even in retirement. And then the longevity, inflation and taxes. As we saw, the inflation is almost 3% right now compared to what it was 3 or 4 or 5 years back. And then the healthcare cost. The moment we retire at 60 or 62, we don't have that health insurance anymore. We need to kick in the Medicare. So Medicare doesn't come free. You need to still pay for Part A, Part B, Part C, and Part D, whatever you need it. And then the fifth biggest thing, what you see here, long-term care cost. So long-term care is so huge, whether it is a assisted living facility or nursing home facility, it can quickly deplete all the savings what we have done over the years. So you want to make sure like there is enough long-term care insurance that you have taken to protect those scenarios. And then the biggest last thing is leaving a legacy. What do I want to leave for my kids? The moment when when we are no longer in this world, what do we want to leave it for our kids? And the biggest thing there, how can we make it tax-free for them? So we can talk days in about all those things, but I want to point out few important things here. This chart will show exactly your stable income sources. So in retirement, Social Security, and if you have a pension, there are a few companies still offer pension that will go into your retirement income. And then variable income sources, your 401k. So 401k, one of the important distinction that we need to make here, 401k is tax deferred money, not tax free. What that means is the money that you're putting right now, you are not paying taxes now, but the moment you withdraw the money, you need to start paying the taxes. So if anyone can say like the taxes are going to be the same for the next 20, 30 years, then that's fine, but that's not the reality. Taxes are going to go up at some point in time. So how can we make sure like that is being taken care? And then your investments, and then your cash value life insurance, if you have all those things, can become a stable income, variable income sources in your retirement. So coming back to the big picture about retirement savings is you need to start thinking now, because you can't wake up at 59 and a half or 60 saying like, I want to retire tomorrow or day after. You need to start working right now.
Okay, great. Excellent presentation, Raghunathan. I have some questions from our viewers. I think you touched on a couple of this already. How much money do I need to retire? You said roughly around 75%. That is correct, right?
Yep, 75%. So I want to make a distinction also here. In retirement, normally if you see, we take retirement into 3 different life stages: go life, slow go life, and no go life. It looks funny, but in reality, that is what it is. The first 10 years of your retirement, let's say if you're retiring between 60 to 70, okay? The first 10 years, you have energy left in you, you want to travel, you want to explore the world. The need for money during the 10 years is little higher. So we call it as a go life, where you want to explore your retirement life. And then the next 10 years, it's slow go life. What that means is you want to travel, you want to explore, but your body movement will deteriorate and you might not able to do what you want. And then the last 10 years is no-go life. Basically, you don't want to be a burden to anyone. You want to leave this world peacefully and without having any issues. So every stage of this, the money comes little less. So we calculate during that, taking into consideration, but generally the general rule of thumb is 75% is good way to start.
Okay, great. Should I take my pension as an annuity or as a lump sum?
So that also again depends. So annuity is nothing but a kind of a paycheck that comes regularly. So if you take it as a lump sum, if you know how to invest, or if you're working with an investment professional who can help you, then you can do it. So annuities also, there are various types you can take it. You can take it for 10 years, you can take it for 20 years. Depends upon, again, I want to go back to the first slide where we talked about the disclaimer, correct? So every time when you do any of those things, this is an educational thing. You need to work with your tax advisor. Your situation might be different. We don't know exactly what tax bracket you are falling in and what is your income needs. You want to make sure like you're consulting your financial advisor, you're consulting your tax advisor before taking any of those actions, but depends again, scenario by scenario.
Okay, very good. This question also may relate to Ashok also. Should I pay off my mortgage before retirement? That's first, Raghunathan, let's ask, or maybe Ashok can chip in.
Okay, I'll go.
Yeah.
So my recommendation, again, same thing what I just said, 30-year versus 15-year fixed. I would not recommend paying off the mortgage, like especially for the inflation reason and everything. I would start putting that money in a good, now some retirement plan or a money market or any of those stock market or anything, but just consult a good financial advisor and go according to that. So that's not my recommendation, paying off the mortgage, unless you are paying very high rate. Right now, the rates are very low, so I would not recommend that. I mean, Raghu can tell more about that.
Yep, that's a very common answer, a common question I also get from my clients when they want to pay 100,000 or 200,000 mortgage that they want to pay. So if you see, there are two types of people in this world. One, they don't want to have any liabilities lying with them so that they can have a good night's sleep. So there are people, they don't care about returns, or they don't care about it's just their emotional buildup that they feel like they're debt free. But generally, if you see the leverage of money, correct? So when you are getting a 2% or 2.5% in for a 30-year fixed, if you can make that money rather than paying, if you can make 3 to 5%, because that is where you need to go and see how the stock market or bond market has performed in the last 20 to 30 years. So S&P almost gave 5.86% in the last 20 years. If you exclude 2008, and March of 2020, right? So the returns are pretty good, but it is the challenge with the stock market. Again, it is not a straight line. So you want to make sure, like, what is the purpose of you need to repay, and how you can make sure like the money can multiply for you. Because if you keep the money into your checking or savings account, it is not going to grow. In the last 15 years, the average return on a checking or savings account was almost 0.04%. Correct. So you want to make sure like how you can multiply the money in a safer way, that we can quickly jump back to the investment fundamentals or philosophy, what you need to be doing those things.
Okay, great. Thank you so much. Excellent analysis. Viewers, if you're joined late, we have two experts with us right now, Raghunathan Rajagopalan from Northwestern Mutual, and Ashok Lakshmanan from the Mortgage Solutions. So they are answering all our basic questions from our viewers and all that. If you joined lately, in terms of mortgage, Ashok was mentioning that this is a great time right now to look for houses. There are a lot of houses in the market, and it's a really good rate. The interest rate is excellent right now, and he was also suggesting refinance if possible. All that. Coming back to you, Ashok, I have some questions from our viewers. What are closing costs?
The closing costs vary from refinance to purchase. So the refinance usually approximately $2,000 to $2,200. Depends upon the loan amount and everything. We will do usually no closing cost. That means we are not adding the closing cost into the loan amount or anything. Plain and simple, we'll just pay the closing cost, and your loan don't change. Your loan is paid whatever you ask for. But when it comes to purchase, there is not that much control in our hand. What means the lenders. Pretty much the lender cost usually approximately $1,000. That's called origination fee or underwriting fee. Most of the time, I will waive that fees for my customers. The rest of the fees from appraisal and attorney fees and title company fees, which picked by the sellers, cost approximately $3,000. Then depends upon what city you are in. There is a city transfer fee also comes to the picture. So I would say anywhere between $5,000 to $6,000 closing costs you should expect when you're purchasing a home.
Oh, excellent. Another customer is asking, can you lock the rate, interest rate, and if you lock it, how long is valid?
So we don't lock the loans, the interest rate, unless you have a home. What I mean, sometimes people think like, I just started looking for a home. I don't want to lose this interest rate. Can I lock the rate? No more. It used to be about a year ago, 2 years ago, where we can lock it for 90 days and you find the home, we'll plug in the address and all that kind of stuff. Not anymore. So you have to have an address. If you change your home, that means from, let's say 123 any street to 678 any street, then that means you lost the lock right there. And the lock, the rates vary according to the locking period. So usually 60-day locks. Most of the banks now offering 30-day locks and 60-day locks, same pricing. So up to 60-day lock, you are good to go. If you want to go beyond 60 days, up to 90 days, you can go on some of the banks, and those rates are going to be higher than 60 days.
I see. I see.
So
Good.
I would not recommend the locking yet. You know?
Okay, great. Is there any prepayment penalty? Somebody's asking.
In Illinois, one of the state where you don't have a prepayment penalty, if you do, your lender needs to offer a counseling for that. It means sometimes people always think like, what if my mortgage loan officer sneak in and put me into the prepayment penalty plan? Nothing to worry, because unless they gone for a counseling, and the counselor will explain to the customer that hey, you are getting into prepayment penalty. Are you okay with that? So then you will find out. So nothing. At least my loans, none of my loans are prepayment penalty.
Oh, excellent.
You can pay extra if you want.
Oh, excellent. Just one more question before we switch back to Raghunathan. Let's say I went around and found a house. How long it now takes to start to the finish in terms of getting the money? Like what is the time frame because of the COVID situation and all that?
Yeah, good question, Raghu. At this point, I used to say like about 20 to 30 days. Still, we are doing, we are closing the loan for purchases 30 to 45 days. I would always ask my customer to give me 45 days window time, and I'll be wrapping up in 30 days. On the other hand, for refinance, nowadays taking more time, anywhere between 30 to 60 to 65 days nowadays is taking. But purchases always get the first priority with me and the bank and everyone. So I would say 35 to 45 days is very comfortable time for us to do purchase loans.
Okay, great, excellent, excellent. Viewers, if you're all ready to buy a house or if you're thinking about it, please consult with Ashok in terms of getting good rates and all that. I mean, there is always, you have time to look for and all that, but consulting with an expert is very advisable. Now let's go back to Raghunath, and one of the important thing, I think, unfortunately, some of us don't do it or postpone doing it, is estate planning. What do you tell us about the importance of estate planning and what is it involved?
Absolutely, that is pretty important to talk about will and trust. Generally, what we feel, correct, being majority of us are first generation immigrants back in India, the trust word itself is a taboo, correct? That creating a will is a taboo. It's only done during the last stage of your life. But in US, it's completely a different story. So who needs to have a estate, and what exactly is estate planning? It's about estate planning is about getting the right things to the right people at the right time in the right way. That's a very simple way to put together what exactly needs to be done and how it needs to be done, who needs to get that. So it doesn't matter. People less than age 18 are married, are having children. Everybody needs to have some kind of estate planning. So the word might look a little different as estate, but it consists of 3 important documents. So what that means is if you're 18 and over, you need to have these 3 essential documents. One is healthcare directive. Basically, it talks about in case of a person gets incapacitated, like if he goes not able to take the decision on his own, somebody needs to take the decision on his behalf. So otherwise, hospitals might have difficulty in getting the person in. So that is one thing. And then second is durable power of attorney for finances. So basically, you need to give for your wife, and wife needs to give on the husband. Basically, you are authorizing to file the taxes, write a check, and all those things. So these are all the 3 essential documents that we need to have. And will is a very basic thing anyone can have, but there's always a confusion, correct? Like people come between what is a will and what is a trust. When should I have a will or when should I have a trust? Again, I'm not a legal attorney. I work with my clients to put together those things and understand those things. So you need to consult your own estate planning attorneys to make sure like how you want to draft your will and your estate planning or trust. So just to give a quick difference between what is a will and what is a trust. The very fundamental difference is, if you have a will, still you need to go through the probate. Probate is court process and you need to go through it. But if you have a trust, you can bypass that. You don't need to go through. So the second point is, can avoid probate and court, including property in other states. Trust is, yes, you can avoid it. In will, you can't avoid it. And manages assets for minor or special need kids. So if anyone has special need kids, like having need to take care of them for a longer time frame, you need to create a special need trust to do that, and can reduce estate taxes. So basically, this is another important topic we need to understand. Starting the current estate tax rules. Okay, so there is a high number we are sitting right now with almost 11.5 million. Till you reach that, you don't really need to pay the estate tax. You have the ability to reduce, but that is going to sunset after December 2025. After this, only for 7 years. After that, it might come down to a lower number. So people are high net worth individuals who are sitting on good assets. They need to start thinking about revisiting their estate planning, how to reposition their assets so that they're reducing their taxes, and ensures privacy, because will is accessible to anyone. So if you register your will in your city hall or in your state, it's a public record. Anyone can go and see. But trust is a private. It is only for you and for your family. Nobody will have access about what you're having. That's a big major difference between having a will or having a trust. And as I said, consult with your estate planning attorney how to do it. If you don't know anyone where to go with, feel free to reach out to me. I put my number and name. I would be very glad to work with you or assist you what other things needs to be done.
Excellent, excellent. I have a couple of questions I am getting from the viewers. What happens if I don't have a will, if I die, but I don't have a will?
So there are two scenarios can happen. One, if you have a beneficiary, for example, for your bank accounts, for your 401k, for your life insurance, all those things where you have beneficiary, that will be taken care. So for your immovable assets, for your house, for your car and other properties, if there is no issues within the kids or within nobody is claiming, like if two people claiming together that this is my property, then they need to go through the court and take that settlement. If there is no issues with that, then they can settle on their own. So it is better to have it, but make sure like all your bank accounts or your life insurance policies or your 401k, you need to have a beneficiary. If you don't have a beneficiary in those things, then it needs to go through the court, and court will decide who is the legal heir to get that. It is a long process.
Okay. The another question is, hiring an estate planning professional is very expensive. Can I prepare my own will and figure out a plan all by myself?
So there is a big challenge there, because all these things we will know whether it is working or not only after you die. Correct? You can create everything on your own and thinking that it is going to work the way it needs to, but you are not going to be there to see whether it is going to work. I know these are all little expensive on the other side, but it is better to spend that money right now rather than having that fear behind us saying like whether it is going to work or not. So I can't tell about this. If they want to prepare on their own, they are taking their own risk. And if it works, it works. If it doesn't work, then they need to figure it out. It is always twice the expense to go back and fix rather than fix at the beginning. Correct? So if they are willing to spend more money later to fix that, they can very well do that.
Exactly. I think it's really a good advice, and it's what advice to look into the will or the trust, and then have everything in safe hands instead of court or the state deciding what to do after your death or something. I have another question. This is typical of probably our Asian parenthood. My parents never talked about their estate planning with me. How do I break the ice?
You know, at some point, it is really important here. If you see a Caucasian couple, when they turn 40, couple of things they do. Really, they know exactly where they want to get buried, where they want to get their piece of land to be cremated, whatever it is, and then they talk about creating a will. As I said earlier, within our system itself, correct? We never fear to talk about death. We always fear to talk about will and all those things. Just bring that process, or just asking the parent what are the things, because think about the cost of fixing that or getting that asset later. Rather it is a conversation that everyone needs to have sooner, so that you know, like, exactly if it is not being done, how exactly that needs to be done. So it is just we have kids are they have all the rights to ask their parents, what are your plans, where are your assets are going to be, are you going to give it to charity? Because here many people, 70% of their assets goes to charity, but we take a step back. We don't do those charity work. Rather we give it, pass it on to our kids. So it is as I said, this is a challenge for the first generation immigrants. Maybe second generation might take the action sooner.
Yeah, exactly. Excellent. Going back to Ashok. Ashok, I have one last question from our viewers. What about the credit check during the whole this mortgage buying house process? How does it? What is a good credit rating, Ashok?
So the credit rating right now, our Fannie Mae standard is 740 out of 825. There is a more than 30 to 35 different kind of credit differentiation in there. You know, people always say like, hey, I went to transunion.com, I'm getting 830, or I went to my bank, or I went to Credit Karma and got some 900. When you pull the credit, it come to be only like 800 or something. I always tell them that everybody use different algorithm, the way they score the credit score. So for our purpose, we need a 740. So just small things like that you should not do. Like when people buy, I always tell them, don't go open up any store credit cards or any like furniture credit cards, those kind of things. Whenever you do, it will bring down your score down. What I've been doing for my customer for the free qualification, I try not to pull the credit. I tell them to go and check the credit with Credit Karma or any other source, free source to get the credit information. With that, I give a pre-qualification. Most of our customers, they know, or most of my customers know that their credit score bad or not when they don't pay their medical bills and some other small department cards. They pay their car payments, they pay their student loan, they pay their house loans and everything, but they miss most of the time small cards like a Kohl's card, Macy's card, or like the medical bills. This is where they make the mistake. So just watch out for the scores and keep it 740 to get a good interest rate right now.
Oh, excellent. Going back to Raghunathan, you have any final summary words for our viewers, and how can they reach you if they need any help, Raghunathan?
Sure, absolutely. As I said earlier, so a couple of things as a family that you need to make sure like you are protecting yourself. Have some good life insurance. It's not going to cost you much for $500,000 or $1 million just to have some good life insurance. Many times I see people skip that. They think like they have insurance through work. Okay, so normally insurance through work, they cover one time of your base pay. If you're making 100,000, that's what they're going to cover. But what they don't realize is the moment either they leave the company or the company lets you go, the same midnight, everything goes to zero. You don't have any coverage. You want to make sure like you are having your own life insurance. Even if something happens, you can have your own life insurance. Second thing is have some good long-term disability. The company might provide 60% of your income as a long-term disability, but I always recommend to keep your long-term disability up to 90 to 95% of your income. The biggest asset any one of us is our earning potential. We can do all this planning that they want to retire at age 60, want to repay their mortgage. Everything can happen. Only the money paycheck they brings every month to the table, husband and wife. If that paycheck is not going to come every month, whatever planning you do, it's not going to work. Whether to send your kids to college or to buy a bigger home, nothing is going to happen. So I would say that is the fundamental thing that they need to have a good risk management strategy. And then start thinking about how to multiply your money. Start thinking about putting in investments and opening a brokerage account. Or another important thing, put at least 6 months worth of your living expense. If you're living with $5,000 per month, keep 6 months worth of your living expense in a liquid cash or in a checking or savings account, because we never know what the scenario we are going through right now. If somebody gets laid off or from work or they're furloughed, you don't want to skip some of those payments. So that's a fundamental thing. Keep 6 months worth of your living expense, have some good life insurance, have some good long-term disability. And then once you cover the basics, it's more of a defensive strategy. Then we can put together to see how we can be more offensive in covering other things. Yeah, they can reach out to me anytime. And I can also, for all the viewers, if they want to do a free analysis of the finances, we can do a 30 minutes review without going through any fee or any cost to them. And if they want to work, then they can start working with me, just going through all those process. I have my cell phone and email address. I would glad to help all the people whoever wants to be.
Raghunathan, close the sharing screen and then let them see your picture where the cell number is there, 414-559-6797. If you want to email them, please look at the screen. They have you have it raghu.r@nm.com, or there is a web page. Please look into it, raghur.nm.com. So either way, you can reach for any kinds of help and your health check, I will call it, because it's very important. Very important. Ashok, final words from you.
Just, take advantage of this great market right now. This is not this is the best time to buy investment property if you are thinking about it. The rents are still low, and just keep your credit scores good and have a happy life.
Thank you. And Ashok's cell, as you can see on the screen, is 630-205-8676. I can vouch for that. Both Ashok and Raghunathan, they are just one call away, and they're very, very happy to help us. I mean, without looking for any benefits whatsoever, it's basically helping our community is what the whole thing is about. And also remember, like we saw that disclaimer in the first screen, this is just for us to just educate some basic information about estate planning or risk management or retirement and all that. But we are actually planning, if our customers want, we will be planning to bring more experts, like we can bring a title company expert or other even an attorney who can talk about the will and trust for our customers. Okay, we can do all that. So thank you so much, Raghunathan and Ashok, for your wonderful expertise. Thank you so much. Hopefully we will continue this in another type of seminar, part 2, maybe a little bit more, because I have so many unanswered questions. I mean, we have only limited time, but there are a lot of questions customers are asking me. So, but we can actually have another session of this one, little bit advanced topics and all that. Dear customers, thank you so much. Next week, Aura International on the 24th, we are bringing wonderful light music, all movie songs, light music, Saturday. All your fun songs we are going to bring, light music. And on the 25th, of this month. It's a Vijayadashmi Day. We are bringing a special Navaratri-based program, what do you call a Kadakala Shebam from Suchitra Balasubramanian from India. She's going to talk about the aspects of Navaratri and also like Kamakshi Kalyanam. Please tune in next week also. Thank you so much, Raghunathan and Ashok.
Thank you. Thanks for having me.
Thanks, Raghu. Thanks to RR International for doing this, and greatly appreciate for the opportunity.
Thank you.
Thank you so much.